chapter analyzes production and cost in the firm. There are two different types of cost. Explicit cost is the opportunity cost of a firm's resources that takes the form of cash payments. Implicit cost is the firm's opportunity cost of using its own resources or those provided by its owners without corresponding cash payment. Consider profits. Accounting profit is a firm's total revenue minus its explicit cost. Economic profit is a firm's total revenue minus its explicit and implicit costs. Normal profit is the accounting profit required to induce a firm's owners to employ their resources in the firm, the accounting profit earned when all resources used by the firm earn their opportunity cost. Consider a firm's decision on production and cost in the short run. Short run and long run. The short run is a period of time during which at least one of a firm's resources is fixed. The long run is a period during which all resources under the firm's control are variable. Fixed and variable resources. A fixed resource is any resource that cannot be varied in the short run. A variable resource is any resource that can be varied in the short run to increase or decrease the level of output. What is the difference between SR and LR for marg? Why is MP is decreasing in the SR? Draw the TP and MP curves. When does the MP become negative? Table of total and marginal product. Total product is the total output produced by a firm. Marginal product is the change in total product that occurs when the usage of a particular resource increases by 1 unit, all other resources constant. Marginal returns. Increasing marginal returns occurs when marginal product increases when another unit of a particular resource is employed, all other resources constant. The law of diminishing marginal return states that when more and more of a variable resource is added to a given amount of a fixed resource, the resulting change in output will eventually diminishing and could become negative. Illustration of the total and marginal product of labor. Costs in the short run. A fixed cost is any production cost that is independent of the firm's rate of output. A variable cost is any production cost that increases as output increases. Total cost is fixed cost plus variable cost, the opportunity cost of all resources used by the firm. Marginal cost is the change in total cost resulting from a 1-unit change in output. Marginal cost is also the change in variable cost resulting from a 1-unit change in output, the change in total cost divided by the change in output. Computing short-run cost data for the smoother mover. Fixed, variable, and total cost curves. Illustration of the marginal cost curve. Computing average cost. Average fixed cost is fixed cost divided by output. AFC equals FC/Q. Average variable cost is variable cost divided by output. AVC equals VC/Q. Average total cost is total cost divided by output, the sum of average fixed cost and average variable cost. ATC equals TC/Q equals FC/Q plus VC/Q equals AFC plus AVC. Graphical illustration of the relationship between marginal cost and average cost. Costs in the long run and economies of scale. The long-run average cost curve is a curve that indicates the lowest average cost of production at each level of output when the firm's size is allowed to vary, also called the planning curve and the envelope curve. Topic of economies of scale. Economies of scale occur if the firm's long-run cost curve declines as output increases. Diseconomies of scale occur if the firm's long-run cost curve increases as output increases. Minimum efficient scale is the level for output at which a firm takes full advantage of economies of scale. The family of short-run average cost curves. Appendix shows a closer look at production and costs. The firm's ISO-quant lines. An ISO-quant curve shows all the technologically efficient combinations of labor and capital that can be used to produce a specified level of output. The slope of an ISO-quant, known as the marginal rate of substitution, or MRTS, is the ratio of the marginal products. MRTS equals MPL/MPC. The firm's ISO cost lines. An ISO cost curve shows all the combinations of labor and capital that are associated with the specified total cost. The long-run expansion path. The family of ISO cost curves and ISO quant curves generate the long-run expansion path. The expansion path establishes the relationship between output and long-run cost, long-run average cost, and long-run marginal cost.